So the tax law in America has given us some wonderful gifts to kind of help us save for retirement. So I'm going to talk about some of these tax deferred or exempt retirement accounts. So the most common is the 401k plan. So this is an employer sponsored retirement account. And so it's called a defined contribution plan. Okay, so this is in contrast to a defined benefit plan, which is a pension. So, what a defined contribution plan is that you and your employer will contribute to this 401k savings account rather than the employee guaranteeing a defined benefit. So, a pension is basically your employer saying, once you retire, I will guarantee that you will receive, let's call it $1,500 a month. What a defined contribution plan is basically, as you are employed during your time of employment, you and your employer contribute to this 401k plan a certain amount of money. And whatever happens after that, you're basically going to accumulate this savings, but it's going to be in investments. And so if the investments crash or whatever happens, the employer is not on the hook like they would be with a pension to keep providing you with whatever it is. So in this way, the employer kind of is just on the hook to give you an amount to save. And then after that, it's going to be dependent on what happens to those investments that are held in the savings account once you retire. So that's why, a lot of companies actually suffered a lot because they had these defined benefit pensions for their employees, and the investments uh, that those pensions kind of held did not do well, but the employer was still on the hook to pay all those retired employees. So, it caused a lot of financial turmoil in certain companies. So a lot of most private sector employers have switched over to this defined contribution plan 401k setup for helping their employees save for retirement, because it's kind of a one and done. Once the employer contributes to the plan, they kind of wash their hands of any future liability. And once the employee retires, they're kind of done, and they go their separate ways. Once you have put some money into this 401k plan, your employer will match some part of it, and I'll talk exactly about what that means. But basically, you'll have a few options on how this money, your and the match from your employers, will be invested. And they're usually in mutual funds that invest in stocks and bonds. So essentially, you're going to put money into this 401k plan out of your paycheck every month. The employer is going to contribute some amount, and then that money is going to be put into mutual funds that are buying stocks and bonds. So your money will be essentially invested in these capital markets, stocks and bonds. And so let's talk a little bit more about what the match is. So as I said, you're going to contribute regularly from your paycheck, and it's going to be matched by some percentage by your employer. So um, the advantage of this is that, for one, you do not pay tax on your contribution. Whatever you are contributing to your 401k plan is exempt, or rather is deducted from your earned income. So again, if you earn $100,000 and you contribute $10,000 to your 401k, then you're only going to be your taxable income will be reduced from 100k to 90k, because that 10k you put into your 401k is tax deductible. Um, Also, the dividends and capital gains that are kind of accruing in the 401k, because the mutual funds will be kind of buying and selling this stuff, that's also deferred. Um, and so basically, when you turn 59 and a half, you can start withdrawing, and the latest you can start taking out from the 401k is 72. And then at that time, you'll be paying tax on that. but it's deferred for from the time you contribute to the time you retire. And so you can expect for one that you'll be in a lower tax bracket because you won't be probably earning anything through working because you'll be retired. And so your tax bracket will be lower. And also just the fact that the 401k funds have been growing tax free for, whatever, 20, 30 years, it's going to be that's a big kind of savings where you're not paying tax on any of that for that given amount of time. And so, what is a typical match that employers offer? So, typically, what they do is they'll match. Let's say you put in $10,000 of your money. They'll what could be considered generous is like a 50% match, where if you contribute 10,000, they'll put in 5,000 of that's the kind of employer match of 50% of whatever you put in. And then there's a limit to that. So usually they cap it, whatever, at 5,000 or 10,000. So uh, it's worthwhile for you to max out that amount if you can afford it, because it's just essentially free money. It's your employer contributing uh, just straight funds that you get to keep once you retire. So it's worthwhile for you to try to take advantage of that by putting as much as you can afford up to the match that your employer will give into your 401k. The investment options are pretty vanilla. Like they kind of are large uh, kind of index funds that will just track the overall growth of the stock market or the bond market and give you kind of safe-ish returns. So you can't do anything too crazy with the funds if you wanted to take more risk. But I think over the long run, if this is a savings account for your retirement, it's actually maybe better that you're not putting them into very risky kind of investments. So um, yeah, so it's worthwhile to take advantage of the employer match up to the limit that they're offering you. And usually it's like some percentage of your income, like 6% is typical. Well, like for example, if you make 100K, the max match from the employer could be 6,000 because that's 6% of your income. And if it's a 50% match, that means you have to put in 12,000, right? So to get the maximum, so if you're making 100K and the max match is 6%, that translates to 6K. And so how do you get the employer to put in the 6K? If they're matching at 50%, you'll have to put in 12K of your money, and then 50% of 12K is 6K from the employer. And again, that's the max. So, it's 6% of whatever you're earning. And so by you contributing 12K, you're going to max out what your employer is going to give you um, at 6K. And I believe there is also a limit to how much you can contribute, because you could keep contributing even though your employer is not going to match anymore. Um, but it would be you would be able to deduct it from your taxes. But I believe there is a max of how much you can contribute to your 401k. So I would check that. Okay, so what if you're not employed or you're self-employed or you're a small business owner? So there are similar accounts that you can open for yourself or your small business, which are SEP IRAs and solo 401ks. So a SEP IRA is for small business owners to establish retirement savings for themselves and their employees. It's similar to a 401k, but there's less kind of bureaucratic reporting requirements. So, this is a whole topic in itself. There's some amount of detail to set it up, but just to put it on your radar of what this is and the possibility of it, just kind of mentioning it here. Solo 401k is for solo business owners with no employees, but has several advantages. So this is kind of like a SEP IRA, but there's some added benefits. Uh, but it's only for if you're a solo business owner, that doesn't have employees. So this is worth exploring if you are a solo business owner. Okay, so aside from employer-related retirement accounts, there's also what are known as individual retirement accounts, which are called IRAs. And so there's two basic types, traditional and Roth. And so what is the difference? So a traditional IRA is uh, a so basically, okay, let me step back for a second. These are basically investment accounts where uh, you basically go to a brokerage. I guess people nowadays are using Robinhood. I don't know if they actually offer IRAs, but let's say you bank with Chase Bank. You can open IRA accounts with your bank where basically you can put money into it and then buy individual stocks, you can buy ETFs, you can buy mutual funds, and it's all self-directed. You are controlling where the money goes. And so it's different than a regular brokerage account in that there are some tax advantages. And so you'd have to open a specific type of investment account with Chase Bank called one option is a traditional IRA. And so the traditional IRA, the contribution is tax deductible. So, like we talked about with the 401k plan, where it reduces your taxable income, a traditional IRA. This is in addition to your 401k. So you can contribute to your 401k at work. You're gonna have some take-home pay, and then from that pay that comes into your bank account, you can then open up this IRA account and separately put money into that. And so that separate amount is also going to be tax deductible. But the rub is that you pay taxes on the back end when you retire. So this is similar to the 401k where there's just a tax deferral. However, there's another option, the Roth, where basically you can contribute to this account. So these are two different types of accounts. When you open your IRA with your broker, it will ask you, do you want it to be a traditional or a Roth? And you can open one of each, which I actually have too. You can have both of them. And then, so let me just talk about what the Roth advantages are. So you don't get the current year tax deduction. Okay, so unlike the traditional, where let's say you put in $5,000 in 2021, you can reduce your taxable income in 2021 by that 5K. With the Roth, you can't. So you put in the 5,000 and you're not able to deduct that contribution from your taxable income in the current year. But you will not pay taxes when you withdraw, when you retire. So this is a tax exempt account. This is a tax deferred account. This is tax exempt. But you need to have earned income to contribute. So we talked about what earned income is. It's different than investment income or capital gains. It's earnings from wages from small business. So in order to take advantage of this tax exempt account, you have to have earned income. So how do you use these two types of accounts to your advantage? So it's better to use traditional when you are in a high tax bracket or in years that you earn more, because you're likely to have you're likely to be in a lower tax bracket when you retire. So it's better to take the tax deduction in the current year since you're paying a higher marginal tax rate, and then just pay the tax when you retire. And in other situations, when you're maybe not earning as much, the Roth is a good option to have. Okay, so what are the advantages of this besides this potential for tax deductibility? There's tax-free trading. So the way I've set up my account is that I have a taxable, like regular brokerage account where I buy investments that I don't plan on selling for a long time. So these are like index funds and just like more safe investments that I'm not trying to speculate on or trade or kind of move around, because I don't want to pay the capital gains tax. Because you only pay the capital gains tax when you actually sell the stock or sell your house or whatever, and you actually realize the gain. Um, However, in my IRA accounts, I have more speculative short-term investments. That's because I can buy and sell these shorter-term investments and not pay capital gains. So uh, it's kind of a reversal. It's a reverse way of thinking, because these are technically called retirement accounts. And so, the idea maybe is to save for the longer term. But tax-wise, if you're gonna be uh, if you're interested and skilled and confident in investing in more uh, risky, higher return, short-term investments, it's better to do it in your IRA, because you will not pay any capital gains. And if it's a traditional, you're only going to pay tax when you withdraw, whatever, years later when you retire. So the tax-free trading is a really big advantage for these accounts. And of course, since they're like so nice, and especially because of this, and the fact that you can deduct from your taxes for traditional contributions, there's a limit. So it's 6,000 per year. However, the amount you can contribute will go down if you earn more. So they phase this amount out, and it also depends on your filing status. So the phase out of this 6,000 is depending on your filing status. So for example, if you're filing single, the contribution phases out from 129K to 144. So if you make 144K or more, you will not be able to contribute anything to these two types of accounts. Um, but for higher income folks, so if you're earning more than the limit, and this is higher for if you're married, but if you're earning too much to contribute, employers may offer 401k plans that are not deductible but have some tax advantages. So that, they're similar to they're not quite going to be the 401k plans where they match, but they'll offer alternative substitute types of tax deferred or tax advantage accounts. So this is all depending on your employer. So it's worth inquiring about the different types of retirement accounts that your employer offers, besides just the regular 401k plan.